So we'll just wait a couple of minutes, Eddie, to let everyone in. It takes a while for Zoom to let the attendees in. Welcome everyone to the Microstructure Exchange. We're waiting for a couple of minutes to let everyone into Zoom, and then we'll start. Okay, welcome everyone to the Microstructure Exchange. Today we're happy to have Eddie Hu here to present a paper about the closing auctions at US equity markets. And the paper is co-authored with Dermot Murphy. And before we begin, just let me repeat the format at the Microstructure Exchange. Eddie has prepared a presentation that will last about 45 minutes, and that includes a couple of question breaks. So please write your questions in the Q&A function. I will be the moderator for the talk, and I will relay those questions to Eddie during the question breaks. And then after the 45 minutes, we will activate the raise hand function, and then you can start asking your questions in voice directly to Eddie. And Eddie has promised to stay on for a bit longer than the full hour to take all the questions there is. And Dermot is here as well to answer questions in the Q&A, and so he may jump in as well to respond to your questions. So with no further ado, I'll leave the screen to Eddie. Welcome to the Microstructure Exchange, Eddie.
Great, thanks, Bjorn. And thanks to the organizers for including our paper on the program, and thanks to everybody for attending today. So today I'll be presenting a paper with Dermot called Vestigial Tales, Floor Brokers at the Close in Modern Electronic Markets. So if you're like me and if you've ever caught yourself watching CNBC during the middle of the day, maybe you've seen, Squawk Alley, and you've seen some guys wandering around in the background, talking to each other and staring at screens. And you wondered, what are these guys doing? Like, I thought all trading happened in New Jersey in servers, data centers. Well, these guys are floor brokers, and floor brokers have played a central role in trading on the New York Stock Exchange since its inception in 1792. And while globally most exchanges have discontinued floor trading in favor of electronic trading, floor brokers are still prominent on the New York Stock Exchange, where they maintain a hybrid model with both floor broker trading and electronic trading. But floor brokers have kind of fallen out of favor, and discussing floor brokers, the economists describe New York Stock Exchange as still living in the horse and buggy era. And this was actually in 1978. So you can imagine that these days, they're probably even less important. But that's not actually true. In the closing auctions, floor brokers are very influential. And that's kind of what we're studying in our paper. So while it's true that floor brokers have been largely supplanted by electronic trading, firms like GTS, Citadel, and Virtu during the continuous trading, during the close, they maintain significant advantages. So chiefly, floor brokers have near exclusive access to the auctions from 3:50 p.m. to 4 p.m. when the auction actually runs. And floor broker orders are actually excluded from the public auction info until 3:55 p.m. And also, many of the electronic trading firms like GTS and Citadel do maintain floor broker businesses. So as you've probably heard, through other talks in this seminar series, closing auctions are increasingly important liquidity events. The closing trade is now the most important trade of the day. These trades determine the end of day prices and thus trillions of dollars of fund NAVs. And closing auction volume has only grown in importance over time, increasing by about 150% since 2012, now representing about 10% of all trading volume. And an oddity of, I guess, history is that unlike intraday trading, closing auction volume is almost exclusive to the listing venue. And in the US, that means the New York Stock Exchange or Nasdaq. And while there's been, some competition for closing volume in the past and in recent history, it's largely true that New York and Nasdaq dominate the close for the stocks that are listed there. And floor brokers on the New York Stock Exchange handle around a third of all of this volume, which represents about $4 trillion of trading across our sample from 2011 to 2018. So the central question of our paper is, what are floor brokers doing? Are they helping, or in this case, hurting closing auction quality? And we measure auction quality as the accuracy of the indicative auction prices, volume, order imbalances, and the ultimate efficiency of the closing prices. And traders, these auction statistics are very important because traders rely on them to determine whether or not their liquidity needs are going to be met in the auction and whether or not they're going to participate. And so in the paper, we kind of look at these market structure differences between New York and Nasdaq to see if maybe one is more efficient than the other, and what role do floor brokers play in that auction design. So in New York, you kind of have this two-period auction structure. In the first period, you have all the regular traders. In the second period, you have, as I mentioned before, exclusive access to floor brokers. And that's kind of what we're going to study primarily. So to give you an alternative perspective, let's take a look at what New York thinks of their own closing auctions. So New York Stock Exchange says that their trading floor helps investors maximize the benefits of the New York Stock Exchange closing auction. They say that their hybrid model offers unmatched stability relative to other global markets, especially during times of market turbulence. And regarding our paper in particular, the COO recently said, the only credible conclusion is that the New York Stock Exchange closing auction, in conjunction with its trading floor, leads to the fairest prices for investors. And, I'm not sure if that's the only credible conclusion, and maybe I'll be able to convince some of you that that is the case with this presentation. All right, so let's get to the preview of the main results. So one of the main findings in our paper is that the indicative prices on the New York Stock Exchange is significantly off from the closing prices when you compare it to Nasdaq. So this chart right here plots the indicative near prices from 3:45 to 4 p.m. and measures the difference in basis points between the near prices that are disseminated in the auction feeds and the ultimate closing price. And New York here is reported in blue and Nasdaq in orange. And what you can see is that throughout the auction process from 3:45 to 3:55, the New York Stock Exchange near prices are about 100 basis points off. Then at exactly 3:55, there's a dramatic jump when the D orders, which come from the floor brokers, are incorporated into the auction statistics. And after that, it converges down to what looks like to be close to 0 basis points, the ultimate closing price. Meanwhile, on Nasdaq, what you see is that as soon as the auction statistics are disseminated at 3:50, there's a quick jump and then a steady convergence to the closing price. Auction volume is also very similar. So the indicative volume reported through the auction feeds is lower than the ultimate closing volume on New York compared to Nasdaq. So what you basically see is, again, about 60% of the total closing volume is accounted for until about 3:55 on New York, where it increases to around 75 and converges to 100%. And at 3:55, this is, a 15% increase in indicative volume, accounting for about $2.2 million worth of trades. Meanwhile, on Nasdaq, basically as soon as the auction process starts at 3:50, the total auction volume approaches 100% very quickly. Similarly, with order imbalances, we see that indicative imbalances are much larger on NYSE compared to Nasdaq. And again, there's a big 3:55 effect where the indicative absolute order imbalances decrease by 21 basis points. Again, 3:55 is when the floor broker D orders are incorporated into the auction statistics. So we also find that perhaps a result of these inefficient auction statistics, that the NYSE closing prices are also less efficient. So at 4 p.m., the auction, the dislocation from the continuous market to the closing price is much larger on NYSE compared to Nasdaq. And these dislocations tend to reverse overnight. On the New York Stock Exchange, it's 2 times more likely. Next, we look at the floor closure during the COVID-19 pandemic, which basically precluded the entry of floor broker orders, but allowed continuous trading to continue. And what we see is that during the floor closure period, the pre-3:55 indicative volume statistics increased from 55% to 85%, meaning that basically all of the auction volume was accounted for. Prices also became more accurate by about 100 basis points, and the order imbalances decreased by around 6 percentage points. And all of these changes reverted almost immediately after the floor reopened in May. So we also look at the resiliency of the New York versus Nasdaq auctions. And what we find is that closing auction quality has gotten substantially worse on New York over time as auction interest has grown steadily. And meanwhile, this hasn't really happened on Nasdaq. Again, reported in orange, has been pretty stable. This is looking at just the near price differences. And New York has increased as volume, which is the gray bars, have increased over time. Moreover, on days with high liquidity demand, auction quality is particularly worse on New York. And we also look at triple witching days and end of month portfolio rebalancing days as exogenous shocks to liquidity demand. And on these particularly important trading days, all of the New York auction statistics are worse.
Should we take a question break here, Eddie?
Yes.
We could do that, but I don't have any questions in the chat yet. So if you have any questions, please enter them in the Q&A function. And while waiting for that, I have a question. So
sure.
If I understand it correctly, the only order that you can use if you want to do any last second or last minute changes is the D order. So if anyone would want to try to manipulate the closing price, they would have to use this D order and maybe try some last second cancellations or something like that. Is that something that you can spot in the data if investors are doing?
That's correct. And I believe in 2018 or 2019, the SEC brought an enforcement action against a floor broker who basically was allowing a client to do a trading strategy that looked like closing manipulation. So I don't think that we can necessarily identify it in a specific way. We could potentially try to come up with statistical measures of manipulation using some of the data that we have, but we probably couldn't prove that there is manipulation happening
Yeah.
without
So,
more detailed data.
would you be able to see, say, second by second changes in indicative price?
Yes, potentially that could be one way to start approaching it.
So that could
So
be
I see that we
an
have
indicator
some questions
for such behavior. Yes, a couple of questions. The first one is from Chester Spath. So why does NYSE argue that the floor design with its last mover advantages to the floor traders is beneficial?
So that's a good question. And we've talked to various trading firms and market participants, and some of them like the flexibility. You know, in their view, they're paying for an option to be able to trade later or cancel later, and they like that. And others who, you know, perhaps don't need that flexibility are totally on board with our paper, and they say, you know, this is largely unfair. So I think that, you know, our paper is kind of narrowly focused on these measures of auction statistics and their informativeness. So we can't fully capture the trading experience of all of the different types of market participants. But, you know, we do point out that there's some potential negative externalities if you look at, say, the closing price efficiency that would affect everybody.
So an obvious question is how you measure closing market quality. And Pete Kyle is asking about this. He says he thinks it should be expected reversal based on deviation from precaution prices in open market. So is your measure standard deviation, absolute deviation, or something else?
Right. So we measure closing market quality. I'm assuming you mean not just the closing auction itself, but the prices itself. So we measure it as the absolute deviation from the continuous market, both the last trade price generally, or the last mid-quote price. And then we look at the reversals to the opening price.
So in the same vein, Jim Angel has a question about basically the result of that measure. What does it say about the quality of the auction price at 4 p.m.?
Right. So what we show in the paper is that maybe I can go back a slide. So what we show in the paper is that the dislocations between the continuous market and the closing auction price is higher on New York. And also these dislocations are substantially more likely to reverse. And so one interpretation of these results is that the closing price on New York is less efficient than on Nasdaq, you know, which could be due to the auction statistics or their unique market structure. In the paper, we mostly focus on, you know, some of the effects related to the market structure and these deorders in particular.
So Jim has a follow-up on that. Do you also compare the closing price at 4 p.m. with the aftermarket trading price?
So we don't look at the aftermarket trading prices, but that's certainly something that we can look at. I'm assuming, you know, the way to do that would probably be to get some VWAP measures of overnight trades as a benchmark to compare the closing prices.
Yeah, that would be interesting. And finally, Chester has a comment, but maybe you want to comment on the comment. This reminds me of the wide implied spread at the open due to the specialist last mover advantages long ago at the NYSE open in the specialist system.
Yes, that's a great point. And actually in early stages of this paper, one thing that we wanted to know was, you know, what is this advantage that floor brokers have? So one thing that we point out in the paper we don't do anything about is that floor brokers actually have access to the complete auction information starting at 2 p.m. And one thing that we wondered to ourselves was, well, why does a very sophisticated HFT like Citadel even bother to have a guy standing on the floor all day? And we thought maybe one reason is that given that they're a DMM with a complete view of the continuous book, having a floor broker gives them even more order flow insight. And maybe there's some way to quantify that total benefit. But in order to do that, we would need more detailed order level data to see, how some of these firms perhaps start trading at 2 p.m. With this information advantage. And we were in this paper, we only look at the public auction feed data.
Okay, thanks, Eddie. The questions keep coming in here, but I think we move on now and then we take more questions later.
Great. So, there are a few papers that kind of are related and inspired our work. So Batalio, Jennings, and McDonald have an analysis of New York Stock Exchange parity rule, which allows floor brokers to trade ahead of same price orders that arrive earlier. And in fact, floor broker orders in the close also do get some execution priority. Mayhew, McCormick, and Spat have a paper that shows that the New York specialists trade in the direction of closing auction order imbalances before they're even publicly reported. So there's definitely an advantage here. More recently, Boguslavsky and Muravyev have a paper that shows that there's strong reversion in the closing prices due to institutional price pressures. And we kind of take that methodology and apply it comparing New York specifically to Nasdaq here. Also, Brogard, Ringenberg, and Roche have a paper that also looks at the COVID-19 floor closure and shows that on the New York Stock Exchange, intraday spreads are kind of increase around the open and the close. So let me give you a little bit of background on how the closing auction actually works before moving into some of the details. So the main takeaway is that the New York Stock Exchange floor brokers have more information and more time to trade. So orders can be entered starting very early in the morning into the closing auction on both New York and Nasdaq. Auction info is publicly disseminated every 5 seconds on both of these exchanges to the prop feed subscribers, starting at 3:45 in our sample in New York and 3:50 on Nasdaq. Then at 3:50 is the cutoff time for the market on close and limit on close. These are that make up most of the auctions volume. And this happens actually on both New York, you can no longer enter, and on Nasdaq, you can no longer cancel. Then at 3:55, the floor broker D orders are included into the auction statistics, and only at 3:59:50 do we have the cutoff time for D orders. So basically, these floor brokers have substantially more time to enter their orders and substantially more time to cancel their orders compared to the people who submit market on close orders or limit on close orders. All right, so as I mentioned earlier, we look at a few different closing auction statistics. New York and Nasdaq both disseminate these real-time stats to their subscribers. And we focus primarily on the near price, which is a price where supply meets demand based on orders in the closing auction, and also the orders in the limit book, the continuous limit order book. We look at the matched volume, which is the number of shares that would clear at the current market price. And we look at the order imbalance, which is the difference between the supply and demand based on the current market price. And notably, the D orders are not included in any of these statistics until 3:55 p.m. on New York. So it's also worth pointing out that the cost to trade in the close is actually quite different and also very lucrative for the exchanges. So on New York and Nasdaq, they charge about 4 cents to 11 cents per 100 shares traded on each side of the closing auctions. That's different than the continuous market, where exchanges will pay a rebate to liquidity providers and charge a fee to liquidity takers. They make money on every side of the trade. And D orders can actually be more than twice as expensive as regular auction orders. So you'd pay like 5 cents to 15 cents per 100 shares to enter a D order, and you may be charged an additional 3 cents to 10 cents per 100 shares to modify your D order in the last 25 minutes of the trading day. So you can probably imagine that these fees can add up to be quite a lot. And we estimate that in 2018 alone, the New York Stock Exchange probably earned between 50 and 100 million in revenue just from closing auction fees itself. All right, but getting back to the hypothesis, basically you can think about the closing auction with two types of traders. In the paper, we can think about benchmark investors that are going to be required to trade at the close or face a large non-execution penalty. These guys will submit aggressively priced limit on close orders to maximize their execution probability. Then we can also think about flexible investors who will only want to trade in the closing auction if they can buy or sell at an efficient price or better. And these guys will submit less aggressive orders to minimize implementation shortfalls. And so on New York, before 350, the auction will only consist of aggressive orders from benchmark investors when the submission fees are lower. And after 350, the participation constraints will naturally reduce competition and therefore auction efficiency. And on Nasdaq, there are no such participation constraints. Everyone is kind of treated the same, and nobody can cancel after 350. So you'll see basically benchmark and flexible investors pull their orders by then. So this gives us a few empirical predictions. The first is that indicative prices on NYSE will be further off compared to Nasdaq throughout the closing auction process. The second is that match volume will be lower. The third is that the order imbalances will be higher. And the final one is that as a result of these higher order imbalances and less accurate statistics, you might expect that the realized closing auction prices will also be less efficient. All right, so the data from this paper is pretty straightforward. We obtained indicative auction information for the universe of S&P 500 stocks from 2011 to 2018 using the SEC's MIDAS system. And we focused on the S&P 500 universe because less liquid stocks don't regularly hold auctions. So by looking at this universe of large liquid stocks, we are able to guarantee that there'll be an auction every single day for which in our sample. And we also obtained some additional auction data from May Street, which is now the provider of MIDAS, for February to, I guess now, May or June, covering the floor closure and reopening. The other variables we just obtained from TAC, the words IID stats specifically. So getting into the empirical framework, as I've pointed out before, what we largely do in this paper is compare the auction statistics for NYSE listed stocks to Nasdaq listed stocks. And we focus in particular on these statistics at 3 time periods: 354, right before the D orders are incorporated, 355 when the D orders are incorporated, and then 359 right before the close. And we look at 3 measures, 3 dependent variables in particular: the near price difference, which is the absolute difference between the near price reported in the auction feed and the final closing price; the paired volume ratio, which is the ratio of the paired volume in the auction feed to the final closing volume; and the order imbalance ratio, which is the ratio of the order imbalance to the final closing volume. And we run regressions of this form here, where we regress one of these variables on an indicator for an NYSE listed stock. We have indicators for 354, 355, 359, and control for various factors and fixed effects. All right, so once we do all of this regression stuff, we basically see that indeed near prices are less accurate on the NYSE. So in the first specification, we see that at 354, the New York Stock Exchange near price differences are about 100 basis points higher. At 355, this goes down to about 60 basis points. And again, this is the difference relative to the final closing price. And at 359, it's about 1 basis point. And if you look at Nasdaq, it's always below 10 basis points throughout the auction process. And that's basically, putting into regression form what you see in this chart here. Of course, then we're able to throw in stock and day fixed effects and also throw in various liquidity controls. Similarly, paired volume is lower on the New York Stock Exchange. So here, the baseline or constant is about 100. So that's, at the end of the day, about 100% of the volume is accounted for. So at 354 on the New York Stock Exchange, it's off by about 40%. At 355, it is off by 25. And then at 359, it's off by 2.6%. And so about 15% of all of the volume is accounted for between 354 and 355. Similarly, that's what we see in the chart that I showed before. Paired volume dramatically increases once the D orders are taken into account. And on Nasdaq, basically all of the volume is accounted for immediately. So looking at imbalances on the New York Stock Exchange, the imbalances are almost always larger. At 354, they're substantially larger. The imbalance ratio, which is the imbalance divided by the indicative volume, is around 50%. At 355, once the D orders are incorporated, it jumps down to 30%. And at 359, it's still 5%. So there's a substantial change in the imbalances of about 20% when D orders are incorporated. And what's interesting is that not only are there large changes in the size of the imbalance, but the imbalances can actually flip as well. And this happens at 2 time periods that are important. So this is basically the probability of a sign change of the imbalance. And you can see that from the constant and from the ones with no NYSE indicator that imbalance sign changes are extremely rare. But at 355, there's a 15% chance that the sign of the imbalance will change. And that's exactly when D orders are incorporated. And at 359, there's an 18% chance that the sign of the imbalance will change. And that corresponds to the last opportunity for floor brokers to cancel their orders. So both of these floor broker interactions have a significant impact on the sign of the imbalance. So next we look at the effect on, or we look at the realized prices on New York and Nasdaq. And here we start by looking at 2 measures of closing price dislocations. We look at first basically the last trade to close in the first column, and in the second column we look at the last mid quote to close. And on New York, the difference is 0.29 basis points or 0.62 basis points, depending on which measure you use. And then in the third column, we look at reversals. So just regressing basically the close to open return on the mid quote to close return. And we see that the reversals are about twice as large on New York as they are compared to Nasdaq. And then we look at the effect of what happens when the floor closes.
Sorry, Eddie, did you want to do a question break there?
Yeah, sure. Looks like we've had quite a few.
We have accumulated some questions. The first one is not a question, but a comment from Andrei Shkilko. It seems that this preferential treatment of floor brokers may be a form of cross-subsidy. That is, the benefit from these folks accrues during the continuous session, and the price for it is the closing auction. What do you think about that?
There's certainly there certainly is some subsidy happening here for the floor brokers. It's not clear to me what they do during most of the day. A good example of that is Citadel. They have a floor broker. During the day, they're mostly doing their DMM business. And then at the end of the day, their floor broker does a lot of activity. So that's certainly, thinking about the business of being a DMM and a floor broker, something that is true.
Okay, so then there is a question from Amy Edwards. How do the near prices compare to the contemporaneous continuous market prices? Do the D quotes push the near price away from continuous market prices? And if so, do the continuous market prices react?
It's a great question. So the continuous market prices actually don't seem to really react to the say the changes in the auction statistics, including the near prices. I actually have a figure for that at the end of the presentation, but given that they don't react, it's not very interesting, so I'll just say it. And one reason that might be is that the people that are posting all these quotes actually do have a complete view of the auction feed, right? The example of Citadel that I gave earlier. So there's no reason for them to be, say, fooled necessarily by the auction statistics or to react to that, given that they know what's in the auction starting at 2 p.m. But there could be, again, like a 2 p.m. effect, or perhaps even like another pre-announcement effect that we didn't look at in this paper, but Chester has a paper on.
So the next question is from Ryan Davis. Do you think there might be implicit collusion among floor brokers? And if so, is it more likely in stocks with lower closing auction volume? And he's pasting a link to a paper with the comment, floor brokers in other contexts appear to have coordinated responses to manipulation.
Yeah, I don't know if we have any evidence, and nothing comes to mind as far as collusion among floor brokers that I can think of. I guess it is theoretically possible. I mean, maybe you're thinking about something like what the Nasdaq dealers used to do, but I'll give that some more thought and see if I can, even find any anecdotal examples of that. But off the top of my head, I don't know.
I just noticed now that Dermot has also posted a response here in the chat. We can follow up on that later, and I'll just take one more question before we continue. That's from Jim Angel again. My recollection is that CBOE now matches off-market on close orders. How has this innovation changed the quality of the closing auction? That's something you have looked at.
Excellent question. And, I was very excited to see that CBOE would be matching off-market, market on close orders. But unfortunately, they launched their competing product in March, which turned out to be a terrible, terrible time to launch a new product. And as a result, I think that not a single trade has happened in the CBOE market on close. I think last time I checked, which was a few weeks ago, there was still zero volume. So, I'm hoping that eventually, when people are maybe a little bit less risk averse, that some people will give it a try, and then we'll get to see what happens, when competition and innovation hits the close.
Great. Let's continue with the last few slides, and then we take more voice questions later.
Great. So probably the last part that I'll get to in this presentation is the NYSE COVID-19 floor closure. So we further identify the effects of floor brokers by by looking at what happens when New York closed its floor during the COVID-19 pandemic. And what was kind of unique about this setting was that the New York Stock Exchange has always had floor brokers since it launched in 1792. And even during 9/11, Hurricane Sandy, NYSE halted all trading. So we have never been able to look at what would happen if we just shut down floor trading. And so during this period, for the first time in history, NYSE actually closed the floor and maintained electronic trading. And this happened in response to 2 people at the exchange testing positive for COVID-19. And important for our paper, although today all D orders are entered electronically on something that looks like an iPad, for whatever reason, during this period, they did not allow the entry of D orders anymore. And so just to kind of visualize what happened between March and May when NYSE closed its floor and then later reopened it, what we saw just looking at the volume right before 355 was a dramatic increase in matched volume. So, matched volume before was around, say, 50 or 60%, and then it increased to between, around like 80 to 85% as soon as the floor closed. And as soon as the floor reopened, it dropped back down to its previous levels. So this is kind of like the shock for our paper that more or less turned the New York Stock Exchange 2-period style auction process into a 1-period style auction process like Nasdaq, which, as you can see from the orange lines, didn't change at all during this period. So looking at the different variables in our paper, what we see is that when the NYSE floor closed, the paired volume ratios increased by about 28%. The absolute near price differences decreased by around 100 basis points, and the absolute order imbalance ratios decreased by just under 6%. And when the floor reopened, we kind of have the mirror image of that. So all of the improvements kind of went away once New York reopened its floor. And then looking at the closing prices, we kind of have similar effects. So the so during the floor closure period, we see that the dislocations increased. We're using both of our measures of dislocations, and once it reopened, these dislocations decreased. But for the reversals, we weren't able to find any statistically significant reversals or continuations. So, here we're kind of being careful to interpret the results, but it could be that these, you have larger volatility going into the close, but maybe these are efficient if they're not being reversed. But it's hard to say given the lack of statistical power that we have here. All right, so lastly, we look at closing auction resiliency, which I'll probably just summarize here. And this kind of speaks to the NYSE's claim that their auctions are kind of the best in the world for times of market turbulence. So we, looking at that question, we kind of show that the New York Stock Exchange closing auction quality has gotten worse over time as closing auctions have grown in importance. Importantly, the auction quality gets worse on days with high auction volume generally, and auction quality is significantly worse on triple witching days, which is when many index-related products expire, and at the end of month during portfolio rebalancing days. So these are kind of specific examples where the New York Stock Exchange auction gets worse for investors. And these are arguably the most important trading days of the year. How much time do I have left, Bjorn?
You have 1 minute if we stick to the 45 minutes strictly, but we don't have to do that strictly. Up to you.
Okay. In that case, I'll highlight one result and then I'll get to the conclusion. So if we look at triple witching days, we find that indicative prices are far less accurate on the New York Stock Exchange. And so in our first stage regressions, we show that on NYSE, on triple witching days, the volume increases by almost 3 standard deviations, and the near price differences increase by a significant amount, 13 basis points, compared to Nasdaq, which only increases by about 2 basis points. And so, on these days where arguably some of the, largest amount of trading occurs, the NYSE auction gets significantly worse for all of these traders. So in conclusion, we provide evidence that the NYSE's auction is less efficient, and we show that it could be related to its unique market structure that advantages floor traders and creates negative externalities for other traders. We show that the NYSE auction quality is much worse than Nasdaq on average, and that the auction quality has been getting worse over time as closing auctions have grown in importance. Notably, we find that auction quality improves during the period when floor brokers are not allowed to trade during the COVID-19 floor closure. And our results highlight, we think, the importance of leveling the playing field for closing auctions. As I mentioned before, some traders that we've spoken to really like the flexibility of D orders, but we highlight the negative externalities in our paper. And this raises some policy questions, chiefly the fact that exchanges have a near monopoly on closing auction trading and the auction data feeds, and they have arguably very little incentive to change. And so some things are happening right now. The SEC is considering adding auction feeds to the public feeds. Currently, they're only available to the private feed subscribers. But one thing that we point out in the paper is that the NYSE feeds are actually incomplete until 355. So that raises another set of questions of, what are some possible solutions to the problems that we identify? Well, one thing that Jim actually brought up is, perhaps auction quality can be improved through competition, things like SIBO market close, which we haven't seen evidence, unfortunately, of people taking that option yet. Another perhaps could be to require the New York Stock Exchange to immediately incorporate D orders into the auction feeds, which we think is probably the most simple approach. And finally, perhaps D orders could be banned altogether. And when the New York Stock Exchange switched over from their previous trading platform to their fully electronic pillar platform, one question that came up was, what are they going to do with floor brokers? And what they ended up doing is basically switching to electronic entry of floor broker orders. So in an alternative universe, maybe there would be a world with no D orders, but it's probably easier in our mind to just fix some of these disclosure issues. All right.
Thanks a lot, Eddie. Very interesting talk. And we have a number of questions lined up in the Q&A. And I'll wait and see if any of you who posted questions there raise your hand, because now you can raise your hand and ask your question in voice. And Andre Skilko has done so I'll let Andre in first.
Thank you, Bjorn. Can you guys hear me?
Yes.
Yes.
Eddie, thank you for the very interesting talk. I apologize if my comment/question wasn't super clear. I was trying to reconcile what you guys show with what Jonathan Brugard, Matt Ringenberg, and Dominic Roche find in their paper. And my understanding is that they look at the continuous session and find that eliminating floor brokers during COVID was a bad thing for the continuous session. So that's kind of where my comment came from, that it could be the price we pay for whatever it is that floor brokers do during the continuous session. But my question to you is a little bit broader. I'm sure that the NYSE had something to say about your findings, and I'm guessing they're defending their structure. I'm curious, what is it that they say?
Yes. So what they said specifically was that the only credible conclusion was that the NYSE closing auction, in conjunction with its floor trading, led to the fairest prices for investors. So you can think about that several different ways. We argue that basically, if you are talking about the closing price, we provide some evidence that the closing prices are less efficient. So maybe they aren't getting the fairest prices. And also we point out the fact that people are paying quite a bit of money for this market structure. So maybe that's not fair either. But arguably, Jonathan Brogaard's paper makes the point that volatility and spreads increase in the continuous market. So maybe if you think about prices for investors holistically, that on balance, maybe people are getting, they're paying less to trade in the day, and the sacrifice is that the close is less efficient. And I think that's probably what you're getting at with your earlier question. So that could be, it's hard to make all of these, it's hard to balance all of these considerations in just one paper, but it's certainly something that I think we should be thinking about in evaluating the state of exchange competition.
Thank you.
Thanks. The next question is by Pankaj Jain.
Yeah, hi, thank you, Jon. So a lot of exchanges, particularly like you've seen the European markets, they are trying to go back to making somebody responsible, like a designated market maker, to provide liquidity. And I know in your paper, you looked at the top 500 stocks, but for like Russell 2000 or the lower cap, less liquid stocks, there still may be a role to designate a floor broker or somebody else to kind of provide two-sided liquidity and make them responsible to keep spreads or price deviations within a range like we have for the limits, limit up, limit down. So what's your thought on examining those less liquid stocks, and what role can the floor brokers play in
Mm-hmm. Yeah, so that's a good point. So for less liquid stocks, part of the challenge is that there just isn't enough auction interest to run an auction. So I'm not sure if, how often it would be useful to have a floor broker there if for less liquid stocks, there's just not enough auction interest. But certainly you can imagine that if there is maybe only one-sided interest, that maybe a floor broker could provide the other side there. Whether or not they would want to do that is a different question, which is why maybe it makes sense to think about obligations. But one thing that I wanted to point out is that, in our paper, when we look at the order imbalances, we show that the floor brokers are not fully reducing the order imbalances on NYSE. So, even at 359, the order imbalance is about 5%. And on Nasdaq, where they don't have floor brokers, it's about 1%. So, arguably just letting everybody in at once to trade is producing a lower imbalance on Nasdaq. And so, the way that we read that is the floor brokers aren't fully stepping in here.
Thanks. The next question is by Pete Kyle.
Hi, I hope you can hear me.
Yes.
So it seems to me that if you're interested in welfare, all this information pre-auction that's about the auction price, it has no significance whatsoever because nobody's trading at those prices. It's just, you could call it information, but you could also call it noise. The true measure of welfare is going to be based on prices at which people trade, and I think it should be the reversal. So seems like your paper is largely focused on something that I would say should be ignored. I actually think the case should be made that you shouldn't disclose any pre-auction information at all. You should just have the auction. and then announce a result. But so if I were the New York Stock Exchange, if you go to, I believe, page 30, and where you show your increase in matching before the close, wouldn't the New York Stock Exchange call that the lost liquidity provided by floor brokers? Because you're not holding constant what the volume would have been in the absence of this mechanism. You're holding constant the actual volume. And they would without any additional information, they would just say, look at all these trades that the floor brokers intermediated that have been lost, and that's a picture of the loss. And similarly, wouldn't they, I think I disagree with that point, because I just said I think all this information is kind of useless. And similarly, if you go to page 32, where you have your insignificant regression, wasn't clear to me what the signs were of those, how to interpret the signs, but certainly the New York Stock Exchange would say there's no evidence that there's a significant reversal.
Yeah, so certainly during the
Between the
floor
close-
closure period, we don't have any significant evidence of reversals, which is why we're cautious to interpret those results. But to push back a little bit on your point about auction statistics, I do think that when we think about auction theory, we normally just think about everybody submitting their orders and trading, and there's no need for pre-disclosure. But you can think about the auction feed as kind of a form of a sunshine trading. People are announcing their interest, and people use these feeds to determine both whether their liquidity needs can be met and whether they think that the prices will be what they like. So people that we talk to in the industry, in fact, do try to forecast the auction liquidity, and so it is important to how they trade. And maybe, I don't know, but maybe part of the reason why they care so much is that unlike what we typically think about in auction theory, where we just have an auction happening on its own, at the close it's kind of weird because we also have quite a bit of continuous trading, and so perhaps this weird market structure where we have both styles of trading happening at the same time is helped a little bit by having these statistics. And certainly at the SEC's roundtable on some of these issues recently, that everybody seemed to agree that the auction feeds were useful for their trading. Whether or not we could do away with them and have more efficient auctions without any pre-announcement is a separate question, but it's certainly something worth considering.
So I think theory would only say that the information about the auction matters to the extent that costs are imposed on people. So, if you require orders to be placed in certain windows or have different fees based on when the orders are placed, that potentially makes the information from the pre-auction useful. Doesn't necessarily mean it creates a more efficient outcome, though. The fact that people find the information useful, to me, suggests that it makes the outcome less efficient, for the same reason that having the floor brokers with inside information, inside insights into kind of what's going on at the auction probably makes it less efficient. They probably would say the information is useful, but
yeah, certainly.
To me, that's an indication that it makes the whole process less efficient.
Yeah, well, I would say that that's certainly true, and I would love to study in more detail what exactly these combined floor brokers and DMMs are doing, so that we can see what kind of benefits they're extracting from this structure, which would hint towards some of the inefficiencies, perhaps.
Yeah. Let me make an additional little point here. It's got this kind of a different point, and that is whether liquid markets benefit the most from an electronic auction or illiquid markets benefit the most. People argue it both ways, and it seems like you either have to argue it doesn't matter or argue it one way. You can't argue it both ways. You seem to be arguing that the illiquid markets don't benefit from the auctions, but yet I think if you look at the history of the Israeli stock market, they used to have these auctions every so often, and the assets are very illiquid. And people used to argue that that's because the illiquid, the auction benefits an illiquid market where people don't want to be continuously paying attention. They only want to pay attention, every
Right,
so often,
infrequently.
like once a day. So the argument goes both directions, and I don't know that theory has a good answer yet as to which way it goes. But intuition is not the way to argue this, because intuition typically is cherry-picked to be inconsistent depending on what the question is at the time.
Yeah, I think we don't have any clear answer to that either. We just looked at the liquid stocks because our understanding was that the less liquid ones, people just don't participate in a closing auction. And that also happens, during like the reopening auctions, when the market halts. But it is a very interesting question.
Okay, thanks a lot, Pete, for all these questions. We have many more questions lined up with the raise hand function, and I'll give priority to those. And there are also many questions in the Q&A. So if you want to ask your question live, then use the raise hand function. Before we continue, we're reaching the full hour here, so I'll just announce that the next webinar at the Microstructure Exchange is by Haoshang Xu, and that's in 2 weeks from now, on the 20th of October. So see you all then, and thanks for coming if you have to disconnect now. But as I said, we have many more questions, and Eddie has promised to stay on for a while to take all the questions. And the next one is by Amy Edwards.
Hi, I had one more question, and that is on profitability of these D quotes. Can you tell, based on the imbalance in the D quote themselves, if they are potentially profiting between the dislocation at the close and the opening price?
That's a very good suggestion that we can look into. I was thinking that we would have to use order level data to answer that question, but perhaps we can proxy for that just using some of these imbalances. So thank you for the suggestion. I think we'll definitely give that a try.
The next question is by Albert Menkveld.
Yeah, Edwin, nice talk. I enjoyed, much enjoyed your analysis. I want to follow up briefly on what Andrei Shkilko was mentioning, because I mean, throughout the presentation, I was thinking, yeah, but these things must be related, right? Whatever's happening, if you give certain people certain privileges at the close, what you hope for is that the fact that they can get rid of some of the position at the close will make them be will make them accommodate more of the liquidity demand during the continued session. And it's nice that the Rogak paper was brought in, and just something to think about. And maybe I missed it, but what you could do is do the obvious trade statistics. See what total volume, for example, does in this period, where in this COVID period, or the Amihud-Illik ratio, or even Abel-Noser type data. If you can get your hands on it, you might want to reach out to Sunil Vahal, who has this connection with a sell-side broker, and he wrote a paper, the anatomy of algorithms based on it, but apparently has a way into the industry, because what you really want to do is see what total execution costs did during this period that the floor was closed. That would be a nice additional piece of evidence. And I just wanted to make that suggestion.
Oh yeah, that's a great suggestion. Certainly, I can say that we're kind of pointing our lamppost at a very narrow part of trading, just at the close, and perhaps even narrower by focusing on 355. And so, we should be perhaps more careful about claims about welfare or efficiency overall, given the Brogard paper and just this question about what are floor brokers doing during the day. So we'll give it some more thought and think about ways that we can think about the floor broker's role more holistically. That's a great suggestion.
Next in line is Eric Budish.
Thanks, a very interesting presentation. I wanted to ask a question on information policy, picking up on some questions Pete Kyle was asking. I was curious if there's a good rationale anymore for the restriction on limit on close orders, that the NYSE having the cutoff at 350, Nasdaq having the cutoff at 358, rather than letting limit on close orders come in all the way up until the auction is called at 4 o'clock. And if you think about it from an investor's perspective, there's two issues. One is that they can't condition their closing market orders on the last 10 minutes for NYSE or last 2 minutes for Nasdaq of information coming from related assets. And then second, they're because of the information policy, they're in a sense obligated to tip their hand to the rest of the market. So if you submit a large order, if your interest is directional, that leaks information to the rest of the market. I guess NYSE would say that that's part of the point. You leak information to the rest of the market in part to then elicit a response from the floor brokers who will help balance out supply and demand. But it just strikes me that it's not the investor's choice when to submit their order, and therefore when to give information to the rest of the market about their demand. You're obligated to give information to the rest of the market before the auction actually takes place. Just it's a strange information policy. I don't think we have definitive theory as to what the optimal information policy is in a batch auction, but I'd just be curious to hear you comment on that policy.
Yeah, that's a very interesting point about the information policies. And you're right that on both of them, you basically are giving up your trading interest for quite a substantial period of time, and you really can't do anything about it, even on Nasdaq. I mean, one solution would be to just do away with these auction feeds altogether. And then, that would be really fascinating just to see if that would affect auction interest overall. But maybe we'll see something, if the SEC goes through and includes auction feeds into the public feeds, more people will see this, and we'll get to see if there's any change in trading behavior, if it attracts any more auction interest. So maybe we'll be able to start approaching your question empirically in the near future. I don't have any good answers here, unfortunately, but it's something that I'll definitely keep in mind.
Great.
Okay, I think it's interesting with these questions. There is the NYSE setup is really unusual in an international comparison, and there's lots of variation in closing auctions if you look outside the US. I don't suggest that you do that for this paper, but I think there are many design issues of closing call auctions that can be studied with nice experiments elsewhere.
I do want to raise one point. In the paper we say a lot of things that look kind of unfavorable to the NYSE closing auction, how they disseminate information, but we've also heard from people that they don't like the Nasdaq model for the reason that basically I think the quote was 350 is an HFT fest on Nasdaq, and we don't really have anything empirically on that, but we do see in the paper there's like really dramatic say near price changes at 350 on Nasdaq. So there is more stuff happening here that we're not really addressing. And there's some effects of how Nasdaq discloses information as well that are interesting, but where we don't have any good answers to yet.
Thanks, Eddie. The next question is by Joshua Molnar.
Hi, hopefully you can hear me.
Yep.
Very nice paper. I actually also have a question kind of related to this slide, and I think maybe some of the things that Eric was talking about here. So my question is, when you were comparing the accuracy of near prices between NYSE and Nasdaq, it looked like what you were doing was comparing accuracy at a particular clock time. But I'm kind of wondering if that's an apples to apples comparison. So, in particular, one issue as we can see here is that there are different cutoffs for submitting market on close or limit on close orders across the two exchanges. If I'm a trader, I think probably what's economically relevant to me is the information that I have at that cutoff time. And so I was just sort of wondering if perhaps you might argue that a more economically relevant comparison would be to compare, say, NYSE's near price accuracy at NYSE's cutoff time versus Nasdaq's near price accuracy at Nasdaq's cutoff time. Thanks.
That's a good suggestion. I think that's probably a fair critique of our, full sample results. I think that's why we were fortunate to be able to study this floor closure period where, nothing really happens on Nasdaq, but something substantial happens on NYSE. And, arguably we could change our Nasdaq baseline there. And, I would think that our results would still survive, but that's an interesting critique of our main results. We'll give it some thought if we can, basically change the comparison unit there.
Thanks.
The next question is by Kiyu Liu.
Hi, can you hear me?
Yes.
Yes.
So I had just sort of a general question related to some of the comments that you've made about what's been going on at 350. Just if you had any thoughts about during the floor closure period, we saw, at least anecdotally for me, and certainly we saw in the news media coverage of increased volatility right around 350. When those, as you indicated in your graphs, the market on close information became disseminated, and I know volatility is maybe a different type of metric than what you were sort of focused on in terms of what you were looking at with respect to quality. But I was wondering if maybe you saw anything in the data, or maybe that might be something worth looking at least. Like I said, anecdotally, during the first week or two of the floor closure period, we were seeing upwards of 1% moves in SPY right around that 350, starting exactly at 350. So
yeah, so certainly that's a good point. And I should say that like the whole mid-March period leading up to the floor closure was also quite crazy in terms of both the open and the close. We don't really analyze it. I think the Brogard paper does a great job of analyzing that. And we were a little bit concerned about whether what we were picking up at the floor closure period might be related to some of this crazy volatility. Which is why we reached out to May Street to get more data to be able to study the reopening period. Anecdotally, by May, things were much calmer in the market. And, we were glad to see that basically, at least for our auction statistics, we had kind of the mirror image effect. Maybe in the continuous market, things might be different. But it seems like the crazy volatility happening in March was not driving our results for the floor closure. But if we do a deeper dive in the continuous market, perhaps we'll be able to answer your question more specifically.
Okay, there are no more hands raised at the moment. If anyone has any further questions, please raise your hand. Yes, there is one. Pankaj?
Yeah, just a quick comment about the aftermarket. So you did mention something I didn't quite get it. Do you compare the closing auction deviation from the aftermarket prices or the next day's open price? And there's a very fairly active aftermarket for most of the stocks these days.
Yeah, that's right. So we currently just look at the next day price, but we can certainly look at aftermarket. And as you mentioned, it's quite active for the universe of stocks that we're studying here. So that might be a, when we're thinking about reversals, perhaps the reversal happens immediately overnight in some of these cases. So that's definitely something that we can do.
We have another question by Eric Budish.
Just one other comment. This is also sort of building off of something Pete Kyle was talking about earlier. But I wonder if you could do a follow the money accounting exercise in the following sense. You mentioned the fees for the closing auctions are high on both NYSE and Nasdaq, and investors are showing a willingness to pay the high fees for a service that the auction's providing, a price discovery, getting a closing price, whatever you want to call a thick market, whatever you want to call that service. There's a clear willingness to pay. So there's the fees, which you tried to aggregate. You mentioned the $100 million a year number, and then I wonder if you also could count up the rent extraction is a loaded term, but just the revenue earned by the floor brokers using directional orders, by using you know who trades and you know what the price is the next morning. So that gives you, it's noisy, but gives you an estimate of revenue paid to the floor broker for the service of balancing supply and demand in the auction. And it'd just be interesting additional color, I think, to add to an already quite interesting, fascinating paper. So it's not necessary for this exercise, but it would just be something I think that could lend further color if you could just do something of a follow the dollars exercise. Again, noting that investors are clearly showing a willingness to pay these dollars for something that the closing auction is providing.
Oh, that's a great suggestion. I guess the idea would be to say investors in aggregate are paying this amount of money to NYSE and the floor brokers, but the reversals or whatever you want to call it cost you this much money. So like just comparing these two buckets, is it kind of worth it? That could be one way to think about some of the welfare effects, and that's definitely something that
even simpler, which is the floor brokers they're providing offsetting interest that's presumably profitable on average. You might be able to add up how profitable the fees are profitable. So yeah, investors you could think of as what they're getting is they're getting a deep market at they're getting a deep market at a regulatorily important price.
Mm-hmm.
So that's valuable. It's a great there are other things that are bundled in.
Certainly all of the auction backup rules and so on.
Right. There's a lot of meat here. It's a really interesting paper. Thank you.
Thank you.
Thank you, everyone. It's a great discussion that we see here. Now there are no more hands raised. So I think this will be a good time to close the session. Thanks a lot, Eddie, and thanks, Dermot, for also moderating questions in the chat. So welcome back to the Microstructure Exchange in 2 weeks for Haoxiang Zhu's talk. And thank you, everyone, for tuning in today. Goodbye.
Thanks, everyone.